Hello, welcome to Strictly Money at the News Forum, where all voices matter. I'm Saijal Patel. There are well over 1 million Muslims in Canada, and for many of them who observe Sharia law, investing in saving for retirement can be challenging. That's because, aside from following strict guidelines, halal investing options are still nascent in Canada. Joining me now to discuss Sharia investing and the considerations is Danielle LeClaire. She's a director for manager research for Morningstar here in Canada. Danielle, great to have you on.
Great to be back. Thanks for having me.
So, Danielle, for those who aren't familiar with halal investing or Sharia investing, can you start by explaining the fundamental beliefs behind it?
Sure. So the fundamental beliefs in halal investing or Sharia investing can really be kind of narrowed down into four main principles. So the first one is they are not permitted to receive interest from their investments. That's a big one. We can probably get into that in a little bit later on when it comes to just kind of bonds. They can't go into highly speculative stocks. So, buying a lot of stocks that have a lot of leverage, day trading, short selling, that type of thing. They also have to share in the profit and loss in their investments. And so, generally representing some form of ownership of the assets that they have. And then lastly, there's a list of kind of forbidden activities, pornography, pork, gambling, those types of things that have to be avoided as well in their investments.
Yeah, so let's talk about the first one that you mentioned, because I think this is the one that's probably familiar to most people, is that you can't receive interest from fixed income investments. So bonds are out, GICs. How do they get around that?
Sure. So bonds are, as we talked about, not permitted because of the interest component, which generally favors the lender over the borrower in that situation. And so something that is a Sharia compliant investment is called a sukuk, and it's actually not a debt instrument. What it is a Sharia compliant certificate of ownership interest in a tangible underlying asset. And so when you're receiving income from those type of investments, it's not actually interest income. What it is a pro rata share based off the amount that you've invested of the revenues of that particular instrument. And so, people might think that sounds like a stock, but it's not, because you actually don't own anything the way that you would with a stock where you have partial ownership.
Okay. This one really surprised me, and that is that you can't invest in a business whose main profit comes from interest. So banks are out, and this is a tough one because financials make up a big chunk of our index, right? A lot of the even pension funds carry it. How do you get around that?
It is a tough one, particularly for Canadian investors, given, like you said, the six banks that we have here. But, honestly, there is no way around it in terms of, they just get a lot of their revenue from this leverage and from kind of mortgages and loans and that type of thing. So it's something to be aware of when you're talking about like diversification. I would say on a global scale, there are some Islamic banks that you can invest in, but those generally are in the Middle East. So not something particularly, available to Canadian investors.
Okay, so then stocks are permitted? Like capital gains are okay, dividends are okay, or does someone have to be aware of the type of dividends that are paid?
Exactly. So there's a nuance with the dividend component. So you can receive dividends, but if you have an investment in a company that even has an insignificant portion of its revenues that come from an impure source, then those dividends, that portion of the dividend needs to be what's called purified. And that purification process is essentially donating that portion of the dividend to charities.
Okay. What about preferred shares then, Danielle? Because that's kind of a hybrid, right? You get paid dividends, but it's at a fixed rate.
Exactly. So there's really two reasons why preferred shares are not applicable or don't qualify for Sharia compliance. And one, as you mentioned, that fixed dividend is essentially interest, similar to a bond. And so that would be prohibited. But then secondarily, within a corporate structure, preferred shares are actually ahead of common shareholders. And so that concept of sharing in terms of the profit and losses, you have an advantage for a preferred share. So that's why they're prohibited.
Okay. We have about 45 seconds to the break. Danielle, how does gold fit in?
Gold is a tangible asset. And so in terms of whether, there's a lot of Sharia investors or Muslim investors out there that do hold a lot of gold just because there is none of these kind of conflicting elements to it based off their principles. So actually a really common thing for them to have in their portfolios.
Okay, so they can actually hold, is physical gold or gold stocks is also fine then, I'm assuming?
Under my understanding, it's fine for gold specific stocks. Now that's different maybe for kind of gold miners or where there could be some nuance in the investments, but kind of hard gold stocks they could probably invest in. Yeah.
Okay, we're going to take a quick break and we'll continue this conversation. We'll be right back. Welcome back. Danielle, we've been discussing what's included and what's not included when it comes to Shariah investing. One of the guidelines, and you had talked about this, is that you can't invest in companies that conduct businesses and in activities that are forbidden, right, by Sharia law. So you mentioned pornography, gambling, alcohol, probably marijuana stocks as well. What I wanted to ask is, would this be considered ESG investing, or is it quite different? And what are the nuances that people have to be aware of?
Yeah, it's a good question and one that I think is really important to dive into because, there is an element or a subsegment of ESG investing that is predominantly values based. And so there's some commonalities there in terms of the screening and from a social perspective, do you want to be invested in those types of stocks out there?
Mm-hmm.
But Sharia investing doesn't necessarily equate to ESG investing. And what I mean by that is ESG investing is explicitly considering the impacts of environmental, social, and governance factors on your investments. And that's not necessarily what we're talking about with Sharia investing. So, for example, a big one is that fossil fuels are actually permitted under Sharia law. And so, a lot of ESG investors would probably not want exposure to that or consider that a bad thing. So that's something to consider. But one of the things I will say is that, along with the push that we've seen generally towards incorporating ESG, we have observed that as well in some of the strategies that we track in other markets about being really, well informed and thoughtful about integrating those factors. So you definitely can find Sharia compliant strategies that are ESG friendly, but I think you have to really kind of take a step back and look at that first to really understand what your investments are.
Okay. What about real estate? I have to think
So
everyone's interested in real estate. So are there considerations that those observing Sharia law have to think about?
if we're talking about actually kind of going out and buying a home from that perspective of real estate, it's definitely permittable. The only compliant, issue to consider is the mortgage aspect of it. So generally
Yeah.
speaking, those who are following Sharia law or, Sharia compliant investing kind of things wouldn't really go near any kind of mortgage opportunity. And so making those down payments would have to be kind of hard cash, I guess you could say, and then kind of go from there. So it is that mortgage element that makes it a little bit more complex.
Okay. So I guess the bigger question is that how does someone who is trying to be diversified and create a diversified portfolio manage this, right? Because it seems like there isn't a lot of options in Canada. It's tough. Well, what's your thoughts on that?
Exactly. So, to be honest, this actually surprised me a little bit. Based off Morningstar data, we did an analysis on mutual funds and ETFs that have either been deemed Sharia compliant or have a name that suggests that they're Sharia compliant. There's about 650 globally, but a lot of those are dominated in certain markets. So, for example, Malaysia has over 300 strategies available to them. In the US, there's only 14. And here in Canada, we only have 2. So, really, that diversification aspect from a kind of, publicly available mutual fund or ETF is not really there. You sort of have to go and do some side investments one-on-one with your advisor. So I really see there an opportunity kind of to grow in the space from a fund company perspective. Obviously, this is an underserved, portion of the population.
Yeah, so they would have to go overseas, I guess, and to be able to build that portfolio, wouldn't they? So go to places like Malaysia, Indonesia, big as well, I would think.
It is. I think it's number 2 on the list when I pulled it. So definitely a lot of exposure there. I will say though, kind of going overseas again from a registered product perspective, there's a
Yeah,
tax implication to consider
there
there
is.
too. But yeah, that would be the only way that they could do it at this point.
So, what are some of the ones that Morningstar does track, and what is available in Canada for investors?
Sure. So the one in Canada that we've seen are it's one called the Global Iman strategy. It's a global equity strategy, and there's also a global equity strategy as well from Wealthsimple. And so, to your comment on diversification, the products are actually registered in Canada, but their opportunity set is global. So that sort of helps a little bit with what they're looking at. We have seen some new entrants. So, for example, Manulife has actually launched a new Sharia aligned product for their group retirement plans, which is a great thing to see. But I still think there's a lot of room there for the Canadian market.
So how do you think this plays out? We have about 40 seconds.
Sure. You know what? I think there's a lot of opportunity to kind of ride the values based investing, stream that we've seen more broadly and really create these opportunities for these types of investors. And, there might even be investors out there that aren't necessarily following Sharia law, that this could be a good opportunity for them as well. There could be some value alignment is also there. So I think an open architecture or open mindset to this type of investing would be a really great thing to see in Canada.
Yeah, I agree. Thanks so much for coming on today.
Thank you so much.
Danielle LeClaire of Morningstar. Stay with us because when we come back, we'll discuss self-directed investment platforms and how to pick the right one for you. Welcome back to Strictly Money. There are 15 self-directed investment platforms in Canada, and with competition fierce and growing, many have introduced commission-free trading to build brand and customer loyalty. But there is more to consider than just commissions when deciding what do-it-yourself platform is best suited for you. Joining me to discuss what those are is Hamish Khamisa. He's the founder of SPARX Trading. Hamish, great to have you on.
Thanks for having me, Saijal.
So we know that fees are important, but there is a lot more to consider. So for those investors who are looking to use a self-directed account, what's the first thing that they should be thinking about?
Yeah, there are a number of different things that self-directed investors have to consider when choosing an online brokerage, but the most important thing is what accounts the brokerage actually offers that they need. So that's the top of mind issue. If the broker doesn't offer what they need, then it really doesn't matter for the rest. But beyond that, then it's going to come down to the style of pricing. So if they're an active investor versus a passive investor, and then the commissions that are associated with that.
Yeah, let's talk about those commissions because there's a lot of platforms, like I said, are doing away with commissions. In your mind, is that a good thing? And are they, Hamish, are they making it up by simply just finding other ways to charge investors?
Yeah, absolutely. So, they're in the financial services space. They're in the wealth management space. It is a service. So they are in business to make money. And there's no illusion that online brokers or self-directed investing platforms are going to find an alternate way to make money from investors as business. But for the front end, it's great to have less of a charge or no charge at all for investors who want to do their own trading and investing. Now, if you're part of a bank-owned brokerage, for example, they have a greater suite of products and services that they can offer you so they can make it up that way and use the online brokerage account as a way to get more and more of your business.
Yeah, I think we have a board that explains some of the fees that people should be watching out for. So let's go through that. We talked about commissions, minimum balance fees. Are these big?
Yeah, they can be, but one of the interesting trends for younger investors, at least, they can benefit from this, is that a lot of the banks and brokerages are doing away with minimum account fees and so forth, but they still apply to account types. So RSPs, for example, are an important account type to look out for minimum balance requirements on, because that's generally where some of the fees come in. TFSA is not so much. But for the older investors, unlike some of our younger viewers, but some of the older ones will have to pay attention to account minimums because usually the young investor is designated as someone who's 30 or younger or 24 or younger, depending on the brokerage you go with.
What about this Forex fees? Because I have a feeling a lot of people might not understand that's really a cost to them.
Yeah, that's a great point. For foreign exchange fees, when you want to trade, for example, in U.S. stocks or U.S. listed securities, some brokerages have U.S. dollar accounts, so you can trade without incurring a Forex hit, and some brokers don't. So they'll force you to convert from Canadian to U.S. dollars and vice versa every time you buy or sell. And then some of the newer zero commission brokerages will actually force you to convert up front and then you can operate in US dollar accounts. So Forex fees are an important place to look out for if you intend to do trading on US listed securities or ETFs.
Okay. Inactive fees, I thought, was also interesting. So they're kind of charging you if you're not trading. Is that it? Is that the premise of it?
Exactly. So in order to make their money, they'll either charge you for having a minimum balance, or sometimes if your activity level is not to their threshold, then they'll pass on a charge. So usually that doesn't apply too much to younger investors now, but more so with older investors. So if you're 25 and above or 30 and above, these are things that you have to be on the lookout for. And again, it depends on the type of account. So sometimes for really active pricing, so you get the best pricing for commissions per trade, they'll waive that. But once you're in that passive investor category, or fewer than 1 or 2 trades per quarter, that's when you'll have to look out for potentially being charged an inactivity fee.
Okay. We have about 40 seconds, Hamish. The last one, transfer fees.
Yeah, that's a big one. There's recent research from JD Power that talked about commission-free trading and also about brand loyalty. So a lot of online brokerage clients are open to switching brokerages. So if you are thinking about looking at another provider, it's important to understand that you will get charged on the way out. But most brokerages that are receiving your business are open to paying for those transfer fees. So just be aware that there is a charge to leave a brokerage typically, and sometimes brokerages on the receiving end will be able to compensate you on the way in.
Okay, good to know. Ask those questions, right? Very important. We're going to take a quick break. We'll be right back. Welcome back. I've been talking about self-directed investment platforms with Hamish Khamisa. Hamish, a lot of the online brokers also provide sort of these value-added features, right? Research, for example. You find screener tools valuable. Can you explain what that is?
Sure. Yeah. One of the hardest parts about doing your own investing is figuring out what investments to actually choose. And so with thousands of securities to choose from, having a tool that helps sift through all of those different names and different securities at different possible investments is really essential. So any brokerage that offers a really effective screener tool, and there are some that are free online and so forth that use Google Finance or other screeners like that, they can help you sort. But really, the more information that you can get around the details of a security and the profile of those securities, if they match what you're looking for, the easier it will be to make investment decisions. And so really the tool that helps sift through a lot of that information is a really effective screener tool. And depending on what kind of investment strategy you have, if you're a technical investor, if you're a fundamental investor, those screeners are really handy.
I think this is a reminder too that just because there are self-directed investments or platforms out there, not everyone should necessarily be doing that.
Yeah, and I think that the qualifier here is that it's become much easier to do your own investing, but it still takes work. It still takes time and effort, and it still takes commitment and discipline to make sure that you're following a strategy. So it's definitely something that's doable, but not necessarily a great fit for everybody who wants to grow their wealth or manage their investments.
Yeah, enter robo-advisors, right? They make it a little bit easier. Hamish, how does one evaluate robo-advisors then?
Yeah, like the online brokerage space, the fees for the service really do matter. And so the kinds of features that you're looking for that associate with the business are going to depend on the different providers themselves. So the easiest thing to remember is that looking for either a fixed rate or a variable rate, so how much they charge you as a percentage of your business, those are going to determine how much you pay. So look for something that at least caps how much you're going to be charged for the service, because I think that's generally where the costs can get higher than having somebody manage it on your behalf, or maybe taking a look at doing it yourself.
How do you see the space in self-directed investment platforms evolving, Hamish? And what do you think the platforms have to think about and offer to stay relevant? Because it is so competitive, the space.
Yeah, it's becoming increasingly competitive here in Canada. In the US, it's a great crystal ball into what might happen here. And so in Canada, there's still some time before commission-free trading fully takes hold, but that trend is certainly well on its way. For online brokerages themselves, I think they have to pay attention to what customers are saying and really making it easy and convenient to do the full spectrum of managing your investments online by yourself. So think about checking on your accounts, thinking about doing all the research, and then in particular around tax time. It's a real pain point for investors that online brokers have yet to fully address, but I think there are some that do it fairly well.
And mobile, I have to think a lot of people are they're trading on mobile, so it has to be mobile responsive.
Absolutely. So, there's the large group that entered the markets, the younger investor, are really mobile first. And so I think we'll see now as the pandemic comes to an end, where people will behave when it comes to trading, but mobile will be that important bridge to connect online brokers and self-directed investors to their accounts and information.
And security, is that a big one that they have to think about?
Absolutely. Like security is a huge moving target. And so increasingly, online brokerages are having to behave like fintech firms, and fintech firms are having to understand financial services, but all of them have to deal with security. And it's a moving target when it comes to that. So look out for things like two-factor authentication or strong policies to help compensate you in the event that your account is compromised. Just make sure that you're doing your due diligence when it comes to keeping your password safe and so forth, to make sure that you do qualify for those risk-free guarantees.
Okay, Hamish, we really appreciate you coming on. And I do want to mention that your website has tools to help investors screen these platforms. You offer deals as well. We have the website coming up there. You can see it on the bottom of the screen. So I encourage everyone to check it out. Thanks for coming on today.
Thanks for having me.
Well, we've come to the end of this episode. To catch previous shows, you can head over to thenewsforum.ca or follow the Newsforum on YouTube. Thanks for watching. Until next time, stay well, stay wise, and stay wealthy.